The very first rule is if you had to file a tax return, then you had to file the tax return. Taxes being filed by you does include your CPA, does include your enrolled agent, does include your tax preparer. All those people are okay. The one thing that is a problem is if the IRS files the tax return for you, that's not you. That doesn't count. And you would still have to do it over again. If the IRS filed the tax return for you, then you would still have to refile that tax return yourself. And then your enrolled agent or your tax preparer says, oh, that was 5 years ago. We can't amend that. And you say, I know. It doesn't matter. I just need one filed with my name on it, filed by me. Nothing has to change. We don't even have to try and change anything. Just file it, okay? Get it over with. Tax preparers like to fight with you on this. We can't amend that. There's no reason to file that. You're not a bankruptcy attorney. My bankruptcy attorney told me I have to do it, so I have to do it. That's the bottom line. So you make the person file it for you, or you file it for you yourself, which is sometimes tricky, but you're not trying to change anything. So it doesn't really matter. You could file it yourself, your signature, you did it with exactly the same numbers. If it's 5 years old, you can't change it anyway. You just have to have filed it, and then you can possibly discharge it into bankruptcy later because you would be filing it late at that point. So rule number one, you have to have filed it yourself. Here's an even better question. Yo, taxes for 2016. Did you file the 2016 tax returns? Did you even file them? I think so. The IRS sent me a bill. Yeah, of course they did. They made it up based on 2015. Whatever they thought you made in 2015, they applied it to 2016, said you owe the same money or more. Because they won't take any deductions for you when they make it up for themselves. They just tell you, you owe this much because you made this much, and even if you didn't make that much, and there's no way to prove it anymore because it's so long ago. But if you didn't file the return, guess what? You think, oh gosh, at some point, even with the IRS, it drops off and you don't owe it anymore because of time. And that's not true if you never filed the return. So how do you double check all this? It's called a tax transcript. You go to IRS.Gov and you apply for and you obtain a tax transcript, and sometimes they'll tell you, oh, that tax year is too old. We'll give you a statement of account. It doesn't matter. Just get one for every year that you think you might have owed money to. You think you owe 2016, 2017, 2018, 2019, 2020, 2021. Go get the tax transcripts. Go get the statements of account for every single year. Rule number 2, if you file your return late, you have to file your bankruptcy at least 2 years after the date that you filed the taxes. So you're looking at, oh, 5 years ago, the IRS filed a return for me. Now I have to file a return. I can't change anything on that return. I just need to file something with my name on it that says that I signed it and I turn it in so that I can get credit for having filed it myself. Then you literally have to just hang on for a couple more years before you can file your bankruptcy, which if you owe a big ton of money to the IRS, you owe them 20, 40, 50 grand, something like that. It's more than the credit cards and the medical bills that you owe. And even though the $5,000 credit card wants to sue you and garnish your wages, but if you're going to get rid of the $50,000 in taxes you owe, you just file the return and you wait the 2 years, and you might be garnished for a few months or a year before you have a chance to actually discharge the taxes. And you know what? It doesn't matter, because even if you ended up paying the whole 5 grand back to the credit card before you filed your bankruptcy to get rid of the 50 grand from the IRS, you get rid of the 50 grand. Plus all of the penalties and interest that go with the tax get discharged with the tax. If the tax is dischargeable, then the penalties and interest are also dischargeable. Hooray, that's actually a win. That's a big win. That's a big win. If you end up losing against a couple of the credit cards, it's still a big win if you owe 50 grand in taxes. Okay, that's the 2-year rule. If you file the taxes late, then you have to file the bankruptcy 2 years after the late filed tax. So then there's a 3-year rule. The 3-year rule says, hey, the bankruptcy must be filed at least 3 years after the due date for filing the tax returns. The due date for filing the tax returns is typically going to be April. If you got an extension, then we're looking at October. So let's say you owe taxes for 2021, and the 2021 taxes were due in April of 2022. Then you filed in March of 2022. When do you have to file your bankruptcy to discharge the tax that you owe for 2021? You file at least April 20th, 2025, or later. But I filed in March. Can I file in March? Can I file April 1st? No, the due date was April 15th, right? But is it really April 15th? You got to look it up and see what was the actual due date for that tax year.
Subscribe so you can catch the next video.
They're not always the same, because if the 15th is on Saturday, they'll have you actually turn it in on Monday. So those are the things you have to consider. You want to make sure that your 3-year rule works. just always plan, especially if you're a bankruptcy attorney, just always plan on filing on April 20th. I mean, unless there's a foreclosure that's going to be on April 16th, then you got to go through all your calendars, look back, what day did the 15th land on? You can actually go to the IRS website and look for what was the date in April that it was actually due.
For that year.
So, actually having filed in March doesn't count. That's not what matters. The due date in April is what matters. I know I've repeated myself several times, but for the people in the back who might not have been listening, or were sipping a cup of cocoa, or chewing on a burger at the moment that I said that the first time,
or texting.
Just make sure that you got it. Because this is important. This is important. You miss any one of these little rules, and you still end up owing the tax when your bankruptcy is over, and if the primary reason for the bankruptcy was to get rid of the taxes, you're punked.
And then maybe your attorney has to pay for the taxes. So, attorneys, you gotta be careful. Before I move on from there, extensions. If you extended to October, you have the same problem as you had in April. It's the due date in October that matters. And then what if you filed 6 months after that and you just did it late? Then you got to go back to looking at the 2-year rule. The 2-year rule says from the date that you actually filed, did you file your bankruptcy at least 2 years after that date? The 3-year rule will almost always cover the 2-year rule. So most of the time, that's going to be fine. So that's you did have to file, there's the 2-year rule, the 3-year rule, and then the extensions rule. There's also an assessment rule. The assessment rule is a fun thing because it can trip you up. The assessment rule is 240 days. You have to file your bankruptcy 240 days after the tax is assessed. And when is the tax assessed? Most of the time, it's right when you file it or when they process it. You file on March 15th, they give it a look at, and they process it at the IRS and tell you owe $5,000, usually somewhere around March 19th, 20th, April 1st, somewhere in there. And then they send you a notice. And the notice typically doesn't say assessment. And you're going, well, it's an assessment rule. How do I know it was assessed? Well, if they send you a notice that says, hey, you owe money. I think under the IRS, it typically would say something like notice of tax due. Anything that says that you owe them the money. That's the assessment. From there, then you have to file your bankruptcy at least 240 days later. When is that ever going to be a problem or come up that the assessment date is after the late filed date and also after the 3-year rule, 3 years from the due date of filing the tax return in the first place? It's rare because you file the tax and typically somewhere within a month or two, they tell you owe the money, and then you end up on a payment plan or something like this, or they tell you that, you don't make enough money for us to actually collect it. And eventually, though, you maybe later are making enough money to actually be collected. And so you come out of that leave this guy alone status where can't collect from him. So then they come after you, and then you got to pay. The 240-day rule can be a challenge if you are audited. That's when the 240-day rule is a problem. I had a client that filed his taxes, and they decided to audit his tax returns, and the audit ended up taking a couple of years. I think it was actually 3 years. So 3 years later, the 3-year rule had passed, the 2-year rule had passed. He actually had filed on time anyway, so the 2-year rule didn't matter. He did, in fact, file, so the you have to have filed rule didn't matter. But it took 3 years to audit the thing, and at that point, he was just past the 3-year rule for filing his bankruptcy 3 years after the due date of his tax returns. So then the 240-day rule had to be calculated from when did they finally say, you owe the money now, the audit is over, it's time to pay. This is how much you owe. And so then we had to, and it's 240 days. You actually have to pull out your calendar and figure out when day 241 is. And it's a good idea at that point to file your bankruptcy, if you're in California, probably over 300 days later. Now, here's a fun thing about California income taxes. All the other rules apply, but on the when did you get the notice from California saying that you owe the money? That rule, this 240-day rule, is a little weird because what California does, they send out a notice that's a preliminary notice. It's called a preliminary notice, and if you go 240 days from that notice, you'll end up owing the money after your bankruptcy is over because they send 60 days later a final notice, and you go from this final notice. You add your 240 days to the date that they sent the final notice. So if the final notice is, March 1st, so April 1st, May 1st, and then you have to look at, of course, was it 30 days in this month, or was it how many days in that month? And then you had the 240 days, and then how many days were in each of those months? Was there a February among those days? You have to make sure that you got the whole 240 days. If you're in California, you go from the final notice and add 240 days.
Subscribe if you think this will help you save taxes.
So how you check You get the transcript for every single year that you owe money to from the IRS, from the Franchise Tax Board, from the Board of Equalization, from taxing authority of whatever state you're in, county, yada, yada. You get all those, and then you have your proof, you have your corroboration lined up, and they say right on them, filed on this date, due on this date, this much was owing, it was filed late on this date, or if it was never filed. So all three of those rules can be discovered on the tax transcripts. So you get your tax transcripts so that you can corroborate and review them and see that rule number 1 was covered, rule number 2 was covered, rule number 3 was covered, everything was covered. Rule number 4, the assessment was done a long time ago, because it'll tell you, we sent out a notice saying that this guy owed the money on this date. Everything is in there. So on that assessment rule, there are a couple of things that extend it. The things that extend it are, if during that 240 days you make an offer to compromise, and either the offer to compromise is pending or the offer to compromise gets accepted, and then the compromise period is pending. If that happens during the 240-day rule, they stop the 240-day rule, and then if you stop the offer to compromise, then the 240-day rule starts to pick up again, but only after 30 more days. So the offer to compromise starts during the 240-day assessment rule waiting period, and somewhere around day 100, you make an offer to compromise. It takes them 90 days to say no. And so that period is cut off there. You add that 90 days to the 240 days, and then you must also add 30 more days. And then there's a second one. The second exception to the 240-day assessment rule is perhaps a little bit worse. Here's what happens. Sometime during that time period, there's a reason why collections are put on hold, called stayed in legal terms, where the IRS is unable to collect. Maybe, hypothetically, you file a bankruptcy at day 100, and the bankruptcy is pending for, give it 100 days, just for fun. At the end of 100 days, they decide not to let you complete that bankruptcy and cancel the bankruptcy. And then, or you decide, if it's a Chapter 13 and you can voluntarily dismiss it, maybe you decided to cancel the bankruptcy and terminate it. Okay, let's say you were at day 100, you added 100 days while you were in a bankruptcy, that's 200 days, so now you still have to complete another 140 days. But before you can even start to do that, you must add 90 more days to the 100 days that your bankruptcy was pending and then got dismissed. See, if the bankruptcy got a discharge, then you'd actually be in trouble. You'd have to wait probably half a dozen or 8 more years before you could file a new bankruptcy and try and get rid of these taxes. If you figured out during a bankruptcy that the bankruptcy that you had filed wasn't going to actually discharge the taxes that you're trying to get rid of, and so you're like, oh gosh, I've got to get this bankruptcy dismissed. What do I do? Oh, I have an idea. Don't complete the second course. That's another video. But don't complete the second course. Your case will get dismissed. And then, instead of discharged. And then you can refile a little bit later. But now, you have to take the time that bankruptcy was pending, add 90 days to it, and then slip that into the middle of the waiting period from the assessment date, or the effective assessment date, to, because in California you have that final notice of tax due. You got 240 days that you have to complete, but then you have to add the time that you were in that other bankruptcy, and then you have to add 90 more days to that, and then your 240 days will be over. After that extra 140 days gets tacked onto the end of that 190 days. So however many days that adds up to. Again, just a quick reminder, this is informational, allegedly educational. It is not legal advice. You're not my client. Unless you actually are my client, you've been to my office and signed a retainer and given me money, you're not my client. Okay. So what happens with Board of Equalization sales taxes in California? This is one where they catch you. This is one that's a little weird. And even if you get it actually done right, in the end, they'll probably still say that you didn't. When you file the returns with California for your sales taxes, and typically that's a quarterly thing, some businesses it's going to be a monthly thing, and then there's I believe a semi-annual and annual sales tax report or return that also has to be turned in. So there's forms 941 and form 940. You're looking at the due dates for each of those quarterly or monthly sales tax returns. And then you got to go 3 years after that. But wait, there's more. And it's meaner. It's gnarlier. Let's say that you own Bob's Burger Shack, Inc., and you file the sales tax returns for the business. The person who filed the actual sales tax returns is Bob's Burger Shack, Inc. So then in California, what happens? You end up closing the business, it doesn't make enough money, maybe you even file a bankruptcy for the corporation, but all the sales tax returns got turned in by the corporation. And then after the corporation is dissolved or closed or terminated, whatever happened. They're going to send either to the CEO or to the CFO, if there is a CFO, whoever was the big guy who owned the place. Typically, the CFO is the chief financial officer. The CEO is the chief executive officer. And when a business closes, whoever owes the sales tax
Under California's responsible person doctrine,
eventually gets a letter from the Board of Equalization that says, hey, just a reminder, now the corporation is gone, you still owe the sales taxes. You're the guy now.
subscribe if this helps you discharge the sales taxes.
And then you file a personal bankruptcy thinking, I'm going to get out of these sales taxes. They'll all be, this is not the sales taxes you're looking for. Well, when you try that Jedi mind trick on the BOE in California, it doesn't work. Here's why. You have to have filed the tax return. And who filed it? Not you. The corporation did. Bob's Burger Shack filed it. You have to turn around and refile every one of those with your name on it.
Or at least one that references all of them.
And it has to be done after they tell you that you're the responsible party. At least I think that's true. You'd probably want to find somebody who is a sales tax expert. So once you're the responsible party, you have to file those returns over again in your own name with your own social and say, I am now the guy who owes the taxes for Bob's Burger Shack's sales taxes. I am refiling all of those returns. I'm the guy. And then they will all be late. So now from the date that those get filed with the Board of Equalization, got to wait the two years because they're all late. And frankly, even if you do it right, the BOE, Board of Equalization, is going to probably tell you you did it wrong and that you still owe the sales taxes because California is pretty horrible about that. They want their money. They don't care. So the main thing with the sales taxes is you have to refile all of the returns that you haven't paid the sales tax for, that you want to discharge the sales tax in your bankruptcy. You've got to refile all the returns in your name, your personal social, and you've got to wait at least the 2 years because now they're all done late. Now you'd think that if you were a sole proprietor and it was Bob's Burger Shack, not incorporated, not an LLC, not nothing, just you and your Bob's Burger Shack and you're a sole proprietor, you should expect that all of the sales tax returns were in fact filed by you. And then the Board of Equalization will still turn around and say, no, we disagree. It was filed by the business. And you're like, I was the business. There's no corporation here. Why are you doing this to me? And they say, well, so what? Pay us anyway. I would love to hear if another bankruptcy attorney has been in that situation and then filed a contempt charge against the Board of Equalization and what was the result.
Story time. I asked a client to get his tax transcripts for me. Here's what happened.
He owed from quite a long time ago. The bankruptcy itself was quite a long time ago. And he was certain that he had in fact filed them all on time and no problems. None of them were even late. And the biggest tax year comes in on the transcript statement of account and it says that he never filed it at all. And that's why the numbers were so big, because they applied no deductions whatsoever, no credits, nothing. That's why the amount that he owed for that tax year was so big, because they thought that he never ever filed the taxes. They apparently thought they never saw them. And he says, well, wait a minute. I was being audited that year for the previous couple of years, and I was in the office. And I figured as long as I'm in the office, I'll give them to the IRS agent at the office, at the IRS office. Handed them to that person. Here you go. And it turned out he got lucky. This was years and years later, but that same IRS agent still worked in that same IRS office. And he went in and he said hello and made an appointment, went in, said hello, said, remember me, I handed you, we had this long audit and it was kind of gnarly. And we kind of got to know each other back then. And I handed you the tax returns over the counter. You stamped them. In fact, I still got the ones that you gave me back with the stamp on them. And so the agent said, yeah, that does sound familiar. She looked them up and she found them. And yes, he had in fact filed them. And then we were getting ready to file the bankruptcy. And I said, okay, now that agent said yes, but the tax transcript we still have, the statement of account, still says no. Let's get another copy of that. So we did. And it had been updated. And it showed that the tax returns had been filed. The most recent date that he went into the office, spoke to the agent, and the agent said, oh yeah, that's true. You did hand them to me over the counter. The day that he had that appointment was the date that was on the tax transcript now. Just a couple of weeks earlier. And so eventually he was able to get a hold of somebody in Washington by a telephone, got him to go ahead and have a look at the account. And then they finally updated the account so that it said that the tax returns were filed when they were supposed to have been filed years earlier. And then it took several months. Eventually, the tax transcript did, in fact, get updated. Got updated and said that he had filed them a long time ago when he in fact had filed them a long time ago. And then we were able to file the bankruptcy then, comfortably knowing that the IRS would then look at his tax transcript when they got the notice of the bankruptcy, and they'd go, oh yeah, 3-year rule is cool, the 2-year rule is not a problem because he filed them on time, and we assessed it a long time ago, and
that is why you get tax transcripts for each year that you owe a tax.